We are joined from Dubai for more details about the global markets. Bhavik Mehta, Chief Market Analyst at Century Financial. Slower, please, I forgot to remind you. Let me start with you with this question. What are markets pricing in amidst this situation of the fear and negative sentiments overweighing on the market because of the developments happening in the Middle East, and at a time that this week we have some data, we have an important decision or a signal from the Fed in its meeting this week? How do you read the picture, Bhavik?
Well, to start with, even before the conflict in the Middle East, the world was already facing the dangers of high inflation. Although the inflation numbers have come down over the last 2 to 3 months, we again have a big new problem for the markets. That is the ongoing geopolitical conflict that has happened in the Middle East. So that has basically made markets very nervous. So we are seeing considerable losses in US equities, US stocks, tech stocks. We are seeing upside movement in gold, oil, as well as safe haven currencies like Swiss franc. So all in all, markets are increasingly positioned themselves to be sitting on a very dangerous edge. So if we talk about the next week's reading, you have the US FOMC, you have the Eurozone inflation and the CPI numbers. So if we go by the last week's action, the markets are bracing for an impact wherein everything goes out very terribly as far as the geopolitical conflict is concerned.
Bhavik, in this context, some people are saying that if the tension causes an increase in US spending that is related to the war, we are talking about the Ukraine war and Israel's war in Gaza, which impacts the widening of deficit, and we could see bond yields exceed their highest levels in 16 years, which they had anyway recorded. So to what extent are those scenarios priced in or potentially possible in your view?
That's a very valid point. Again, even before the start of this war, the US Treasury announced a couple of months back its total Treasury supply issuance for the year of 2024. Now, even before this crisis, they had announced a huge spending increase of around 25 to 30%. So immediately after this kind of news broke out, we had the long-dated bond yields rising. That is a rally that you are currently seeing in the 10-year and the 30-year yields. So again, if US is already running a record amount of fiscal deficit, so for the recent year ended September 30th, the US is printing something like 1.5 to 1.6 trillion dollar deficit. Economists on the Wall Street expect the deficit to rise to 1.8 to 2 trillion. That is around 7 to 8% of the GDP. So this has, along with the past inflation increase, pressurized the bond yields to a lot of extent. And one of the reasons that we have seen decline in even the good value investment grade bonds, and the Fitch agency cutting the US credit rating to AA.
Bhavik, we saw end of last week a lot of economic data. The PCE, preferred measure for the Fed, we saw some corporate results. Maybe the impact of those policies, of the tightening policies that to fight inflation has started to give results. Recent data, in your view, does it support the idea of interest rates remaining higher for longer?
Interestingly, the global economy, we are witnessing two different trends from both the major economic hubs, that is US and the Europe. So if you look at the latest PMI data from Europe, primarily led by Germany and France, past impact of tightening is being fully felt across the corporates as well as in the consumer spending. This was something that was officially highlighted by ECB Chair Lagarde. Compare that with US. So we just saw last week the US GDP data release. Again, a mind-boggling and blockbuster print where the GDP came in above the expectations. The consumer spending was very healthy. So factually, if you go to look with the numbers and all, the US is probably absorbing the tightening in a more positive, in a more better manner as compared to Europe. So probably higher for longer does arise as far as the US economy at this point of data is concerned, at this point of time is concerned. But if you talk about Europe, we could be pricing in a scenario wherein the rate could start maybe from mid or late next year.
This is the question. Since you started talking about your recent data showed recession symptoms in Europe, do you think this supports maybe not speeding up, but the idea that we will not see a change in the forecast of ECB really starting to cut interest rate maybe in the middle of next year or next fall?
Absolutely. If again the GDP data for Q4 specifically from Germany, if it comes around in a negative manner, that is below 0%, we could be again staring at a technical recession probability. That will primarily force ECB's hands, first of all, not to increase the rates, whatever the inflation happens, but maybe also looking at a scenario where you could be having markets pricing in more aggressive cuts by the ECB and ECB also turning more dovish.
With all the data that are coming out and what you said regarding the US, with all the data that are showing this resilience in the European economy, US economy, resilience of the US consumer, that they are able to adapt to current situation. Don't you believe that the idea of cutting interest rate for the Fed is priced out, even if we expect this to happen sometime next year? Don't you believe that this is exaggerated forecast or expectation? Because it's unlike what Powell and the Fed says. They say, as long as we see resilience, this opens the door, not for keeping interest rate higher, but even hiking it if it is needed.
If you look at the historical, how markets have always reacted, how traders have always reacted to the Fed funds futures. First of all, let's go back. So when the rates were low, markets were nervous that inflation will increase, there will be rate hikes. Now when the rates are at a very high territory, the bond yields are high, markets are over optimistic. As you rightly pointed out, they are seeing some big light at the end of the tunnel. They feel that there's going to be a very bad recession, a big chance of hard landing, and the Fed is always going to cut more aggressively. So there is always a disconnect between what the markets are pricing in, what the Fed fund futures rates are trading, and what the Fed is actually going to say and actually going to do. It's always that markets want to be optimistic in a way. Investors need to be optimistic because they want good long dated returns from their equity holdings. 2022 was bad for equity markets, and the way we are seeing in the October month, the markets are likely positioning for more drop in the November, December months. So this disconnect is something that's always going to continue as far as trading is concerned.
Bhavik Mitta, thank you so much for having
Thank
joined
you.
us from Century Financial. Have a nice day. Thank you. You have joined us from Dubai. Thank you. I hope to see you again on the show.
Thank you.
Thank you.